Welcome to Biblical Economics 2, and this is week 3. I am your professor, Dr. Jonathan Vorse, the Chancellor of Covenant Bible College and Seminary. This is just an overview of some of the practical things that you can do when it comes to your finances. Once again, we do not claim to be investment advisors. This course is designed to give you some starting points and some starting places where you can reach out and try to maybe put together a plan for yourself, hopefully with the help of a great investment advisor. All right, as with all of the other courses, let's go ahead and open in prayer and ask God to help us. Heavenly Father, we come to you today. We thank you, Lord, for the wisdom that you have given. We thank you that your word is full of wisdom. We thank you that you have blessed us with other people who have wisdom that has helped us put together these curriculums. I pray, Lord, that you would help me be able to effectively give them the overview of what they should study. Holy Spirit, guide and direct in Jesus' name. And everyone said, amen. All right, we're going to jump right in here and we're going to begin by talking about purchasing large ticket items. Today we're going to talk about purchasing an automobile, and we're going to talk about purchasing a home and some of the things that you need to look for and be aware of when you are involved in those types of big ticket items. First of all, purchasing an automobile can get more people into financial dilemmas than any other significant expenditure. I know that when it comes to purchasing an automobile, it's not always the best idea to purchase something brand spanking new off the lot. Now, if you like the warranties and stuff that come with it, and if it will work for the lifestyle that you have, then that is great. But some people are purchasing automobiles right off of the lot, brand spanking new, when they could purchase something a year or two older and save themselves potentially thousands and thousands of dollars, and then just buy an extended warranty and get a very, very good deal for pennies on the dollar of what they would get if they got it brand new. And so also when you purchase an automobile, as soon as you drive that automobile off the lot, it decreases in value. And the more that you drive it and the more time that goes by, it just keeps continuing to decrease in value as time goes on. So most of the time when you want to have an investment, you want to have something that is going to increase in value. Now, we understand that it's important to be able to drive a good vehicle, and we do understand that sometimes repairs can become more than a payment. And so you just have to kind of find that balance and try to make the right decision based on your personal circumstance. But we're going to talk to you a little bit here. Now I want to start talking to you just a little bit about purchasing a used car. And so here are some of the questions that you can ask the dealership. You can ask about the dealership, ask around about the dealership, ask friends, ask neighbors, ask coworkers, and find out if anyone has ever used that dealership before. And if they have, what is their reputation? Do they have a good reputation? Do they have a bad reputation? I don't know that I would rely a whole lot on things that you would see on the internet, as there could be people, that they like to get on the internet sometimes and try to create a bad reputation for people by signing under different names and things like that, and just trying to drive someone's reputation in the ground. You want to ask somebody who knows about that dealership and who is familiar with that dealership. You want to ask them and be able to gauge the reputation from that. And then you want to ask, how are their finance companies? When we talk about how are their finance companies, are they going to immediately charge you a large financing fee? Also, are they going to be trying to sell you a product, a financial product, to purchase that car with a very high interest rates? Also, you want to ask, are they fair with their customers? So are they credible? Are they fair with their customers? How long have they been in business within that same community? So if you're asking around and no one's ever heard of them, they may not have been in the community very long. But you can ask around and you can find how long that they have been in that community. What is their warranty like? Do you have a warranty? What kind of warranty do you have? Is it a 30-day warranty, 60-day warranty, 90-day warranty? Is it a mile warranty? Is it a year warranty? What kind of warranty is it? Is it bumper to bumper? Is it just drivetrain? So ask around. Word of mouth is a great source of information when you are purchasing a new car. When you finance, or a used car rather, even a new car. When you finance, you should go through your bank or your credit union for financing if possible. You say, why should we do this, Dr. Vorse? Well, the reason is because you already have a reputation with that credit union or that bank. But the biggest reason is probably because you're going to get a better deal through your credit union especially, or your bank. So I always like to try to tell people, try to limit the loan to 3 years. But if you cannot limit it to 3 years, definitely do not limit it to any more than 5 years. If you have to pay more than 5 years for that car, for a car, you cannot afford it. So by the time you get your vehicle paid off, you may have gotten tired of it, you outgrew it, or have more wear and tear on it than you're comfortable with, and you'll want to trade it in. And so this is how people get upside down on cars, and this is how they get messed up financially. What happens is they'll take that car back to trade it in, and they'll owe more on the car than what it's worth. But some of these car lots, because they need to make money and because they want to make sales, will work some type of a deal where you'll be able to get into a different car, and they'll take what you owe on the previous car and tack it on to the cost of purchasing the car that you have. And so in doing that, you get upside down. And if you don't watch it, then you will end up getting into that cycle of always owing more for your vehicle than what it is worth. And so you don't want to get into that cycle. So the best way to do that is to limit the loan to 3 years and at the most 5 years. Now, as far as the trade-in, you want to watch your mileage, log all your maintenance, and never trade in for less than what you owe. Sometimes you can get more money if you just sell outright. Owning your car outright is a great feeling. Having a free and clear title and not making monthly payments can definitely generate relief. It can generate joy. I know we don't owe anything on our car, but for several years we had a payment, and it was just a relief to be in a situation where we no longer have a car payment. And so sometimes the best way to do it is to purchase a car outright. If you don't have to travel a whole lot, if you don't have to go a lot of miles, maybe you just need something to get back and forth to work and get around town, it might be better for you to just try to purchase something that's inexpensive outright, that if it breaks down, you can just call a friend and they can come and try to help you out. Over the long term, the money that you save and invest, one of these days you'll be able to go buy that car that you want. But don't buy the car that you want in the very beginning and then strap yourself with debt for the rest of your life. You don't want to do that. So when you're going to purchase a vehicle outright, first of all, make sure that you are getting a clear title. You want a clear title. That means it doesn't have any liens on it. That means that there's no money owed on it. And so if you're purchasing that vehicle outright, you want to make sure there's no liens on it. So you're purchasing from a private owner, and make sure when you purchase from that private owner that you are purchasing from the owner and not from someone else. Sometimes people will scam. They'll do what they call jump title. And when they do that, they'll purchase the vehicle from someone. They'll tell that person to leave their name off of it, and then it'll be signed off. And then when you purchase that vehicle from the individual, then in the eyes of the law, you actually purchased it from the people that they purchased it from, because they didn't sign, the people that you're buying it from didn't sign onto the title. So what they're doing is they're jumping title. So in the eyes of the law, you did business with somebody you don't even know. And so that could really create some problems for you. So you want to make sure that the person that you are dealing with is the person who is named as the owner on that title. You'll also want to get what we call a bill of sale. A bill of sale is a document that details the terms of the sale of a vehicle between a buyer and between a seller. And once completed and signed, it can be used as proof to your local Department of Motor Vehicles, your DMV, that a sale has occurred. And so that's just kind of a quick rundown on some of the things that you want to look for when you're purchasing a vehicle. Another thing that I want to mention that I don't have a slide for here, and it may not even be here in the curriculum. I don't know. I haven't really been reading through the curriculum as I've been going along. Just been working off the slides, and you need to read that curriculum. But one of the things you need to make sure of is how much your insurance is going to cost you. And so you might want to call and ask your insurance company, what's my insurance payment going to be every month on this vehicle before you purchase the vehicle. So that's purchasing a car, and that's just kind of in short. All right, now, purchasing a home. A credit score is very important. Your credit score is very important to help you qualify for a lower interest rate. If you're in the subprime category, then your credit score is going to be really high, and your payments are going to be very high, and you're going to be paying a whole lot of interest. You want to make sure that you are ready to purchase a home when you purchase that home. So there's different ways that you can go about doing that, but that's very important. Your credit score is very important. So learning your credit score gives you an idea where you will stand with the lenders and whether it makes sense to work on strengthening your credit before you apply for a mortgage. Remember that. Now, in order to afford a home, you're going to want to keep your housing expenses to no more than 25% of your monthly gross income. That's not your bring home, that's your gross income. So if you want to afford a home, if you feel in affording a home, if you have a gross income of $4,000 a month, then you do not want that payment to be any more than $1,000 per month. You do not want it to be over 25% of your monthly gross income. Also, location is very important in determining the house that you should purchase. You know, every city has distinct neighborhoods with its own personality. So how you want to live will determine what you'd like, where you'd like to live. You know, there are some places that are what we call mixed-use communities. Here in Florida, there's places that you can live. They call it living at home in a resort lifestyle. There's other communities where they actually have beautiful shops and stuff on the lower level, and then there's a couple or three stories above them, and there's condos on those 2 or 3 stories. And you could literally just stay in that community basically for the rest of your life if that's what you wanted to do. You don't have to, but if that's what you obviously wanted to do. So depending on how you want to live. Now, if you have more of a tendency to be out in wider open spaces and have a little bit more room and have a little bit of acreage, which is kind of like we are. We kind of like to go out in the back and have the little bonfires and have the s'mores and gather the family around, and we don't want the neighbors hollering when somebody squeals out in laughter and has a lot of fun. We really we're the type of people that want 4 or 5 acres. We need that for our family. But there are other people who that's just not the life that they want to live. They don't want to have to mow the grass. They don't want to have to do the landscaping. They'll pay a condo fee, and we'll talk about that in a few moments. But that takes care of the roof and takes care of the outside, and really all they have to do is just make sure that everything on the inside is maintained the way that they want it to be maintained. So it depends on how you want to live, which determines the type of home that you purchase. So you have the condos there, and you see those there on the left, and a lot of major cities have that. Here in Tampa, we have those, and they're beautiful down by Tampa Bay, and many of them are 14, 15 floors or more. Those are beautiful. Then you have the traditional homes, and the traditional homes is the standalone homes, and there's no one else in there except your family. That is generally the way that it's supposed to be, or the way that it is. Then you have what we call townhouses, and townhouses are houses that are kind of like individual houses, but they're attached to one another, and so there can be a shared expense sometimes when it comes to the townhouses. And so there's so many different things that you can do when it comes to so many different homes that you can have or things that you can look at when it comes to purchasing a home. So what kind of lifestyle do you want to live? Now there's some fees that you need to think about when you're looking at purchasing a home. One of those fees is what we call the Homeowners Association fee, or the HOA fees. HOA fees are very important. HOA fees can be very expensive, or they can be minuscule depending on the neighborhood and what is offered. Some HOA fees actually take care of all of the lawn, they take care of all the maintenance, they take care of the roofs on the houses in the community, they paint the outside of the houses, they make sure the roads and the sidewalks and everything are fine, and sometimes they even pay for trash pickup and water and basic cable and things like that. And so, you're going to pay more for an HOA fee in that community, but you're going to get a lot more amenities. HOA fees in other communities are a lot less than that, but then you're going to pay for your lawn maintenance, and you're going to pay for your basic cable, and you're going to pay for anything that goes wrong on your home, and you're just going to have to pay for all of that yourself. So you need to ask yourself, how much is my HOA fee going to be, if there is indeed an HOA, Homeowners Association fee. And then when you find out what it is, ask what amenities it includes, and then you can work that. You have to add that every month to what your payment would be, and then you can kind of work that and decide if you're able to afford that home. Then you also want to think about the property taxes. You will pay your local government's property tax rate and your home's assessed value. Now, sometimes you can get homestead exemptions and things like that, or sometimes you can get homestead exemption cut on your taxes. But your property taxes can change every single year, which can change your payment just a little bit every single year. Then you want to think about homeowners insurance. Your mortgage companies are going to require insurance on a home before they will loan on it. So to just look at a loan calculator and say, well, this house is $250,000, and this is what the payment's going to be on a mortgage calculator, and just based on that $250, and then they say, well, it's so much interest, and this is what it's going to be. Well, when you get that payment, then you need to add to it your HOA fees, your property taxes, and your homeowner's insurance. And that's going to change your payment quite a bit. And so that will help you decide whether you can afford that home that you're wanting. Now, what if you've owned the home for a while and it's appreciated in value and you want to sell the home? Let's talk a little bit about that. Well, selling your home, buyers are always looking, you need to understand that buyers are always looking for a good deal. So you want to make your house look great. It's basically the same thing with your car. You want to detail the car and prepare the maintenance logs for review. But when it comes to selling your home, a coat of paint on the outside of the house can greatly up the curb appeal of your home, and you'd be surprised at how much more money it will get you if it just looks nice. Good landscaping can help a home sell, and can also get a much better value. A lot of people actually do what they call flip houses. And what they'll do is they'll buy a home, they'll paint the inside of it, fix the floors, maybe change up some cabinets, do a little maintenance, make it look really nice. Then they'll go outside, do the same thing, check the roof, make sure it's what it needs to be, do the landscaping, fix up the yard, make it look really, really nice, and they'll put it back on the market, and they'll make $30 or $40 or $50 or sometimes even $100,000 when they flip that house. And so if you're wanting to sell your home, you need to make sure that it's in tip-top shape, and you need to make sure that it's always looking good and that it has great curb appeal. Same with your car. If you're going to sell your car, you don't want to put your car on the market and it all dirty and nasty all of the time. If you're going to sell your car, you want to make sure that it's clean. You want to make sure that it's detailed out, and you want to make sure that there's maintenance. If you have maintenance logs, that they are there for people to take a look at and for people to review. And so that's very, very important. So those are two things there that are big ticket items. You want to think about maybe purchasing a car, purchasing a home, and then maybe selling the car and selling the home. So hopefully those were a few pieces of advice that will help you. Those of you that are in brick and mortar, I say brick and mortar, local extension campuses, just go ahead and hit the pause button here. We're going to take a little bit of a break. And obviously I didn't read through all of the curriculum here. You're going to need to read through that. You're going to need to discuss it. You're going to need to talk about it. And those of you that are here online, I'll be back in just a few moments. Okay? Let's take a little bit of a break. All right. Well, welcome back. Those of you that are online, we are going to go ahead and jump in here. And in the next section, we're going to be talking about preparing for retirement. And once again, I'm reminding you, this is just a video overview. You're going to need to continue to, you're going to need to read your curriculum and study your curriculum in its entirety, read your textbook, okay? But I'm just giving you an overview here. So we're going to talk a little bit about preparing for retirement, and we're going to talk a little bit in this section about retirement vehicles. We're going to talk about IRAs. We're going to talk about traditional and Roth IRAs. We're going to talk about mutual funds. We're going to talk about real estate, pension funds, stocks, bonds, and investment fees. So that's what we're going to talk about. Let's begin by talking about IRAs. An IRA is an individual retirement account. So that's the acronym. IRA is the acronym for individual retirement account. The big advantage is that you can start withdrawing from an IRA tax-free beginning at 59 and a half years old with a mandatory delivery at age 72. So once again, let me say this. You can begin withdrawing from an IRA tax-free. That's important. Tax-free beginning at 59 and a half. And so then you have to have it withdrawn by the time that you are 72 years old. And so another significant advantage is that you can place beneficiaries and not be taxed to pass the assets to them. So that's another advantage, being able to pass those assets to your loved ones. So let's talk about a Roth IRA. A Roth IRA lets you accumulate earnings on a tax-deferred basis and withdraw earnings tax-free for qualified distributions. So unlike a traditional IRA, contributions to a Roth IRA are not deductible on your federal income tax returns. So traditional IRAs allow you to deduct, but Roth IRA will not. In 2021, you can make annual contributions to a Roth IRA of up to $6,000 or 100% of your earned income, whichever is less. So you got to check with your banker for the yearly contribution limitations after 2021. This has been prepared in 2021, and so you'll need to check with them after this year. Current law permits most couples who are legally married and filing jointly to contribute up to $6,000 each, so that'd be a total of $12,000 as long as their combined compensation is at least $12,000. This allows a spouse with a lower or no compensation to take advantage of the tax savings offered by an IRA. The annual contribution limits apply to the combination of all your traditional and Roth IRAs. If you are age 50 or older, you can make an additional $1,000 catch-up contribution to your IRA. That is great. Contribution, non-interest earned dollars, may be withdrawn at any time, penalty and tax-free. Earnings on the account accumulate on a tax-deferred basis. They can be withdrawn free from federal income taxes if the withdrawal is a qualified distribution as defined below. The Saver's Credit may provide a tax credit for those who save for retirement. You may be able to take a credit of up to $1,000, up to $2,000 if filing jointly. The credit applies to the first $2,000 contributed to a traditional IRA, Roth IRA, simple IRA, or 401k account by reducing the amount of federal income tax you owe dollar for dollar. The credit ranges from 10% to 50% of your contributions and is based on your filing status, adjusted gross income, and tax liability. Now, a little tip. This comes in very useful when your income is right close to the line of switching over to a higher tax bracket. So if you're able to get dollar for dollar and keep it under, then that can literally save you a lot of money when it comes to having to pay your taxes. So you don't want to go into a higher tax bracket unless you have to. Now, if you have to, then you just praise the Lord because, He's blessed you to the point where you are actually in an even higher tax bracket than what you were before. But you can do several things to keep yourself in a lower tax bracket, just having your money work here and work there and moving it around here and move it around there. And so this is one of those vehicles that can be used to try to keep you just under the wire of having to go into the next tax bracket. Now, a Roth IRA conversion. A Roth IRA conversion is a taxable movement of funds from a traditional SEP or simple after 2 years IRA to a Roth IRA. A conversion may also include a rollover conversion from a qualified retirement plan, including a 401k, a 403b, a 457b, or profit sharing plan to a Roth IRA. Amounts converted are not subject to the federal 10% tax penalty until withdrawal. So here's some of the rollover rules. In general, you have 60 days from the date that you receive an IRA or retirement plan distribution to roll it over to another eligible plan or IRA. So you don't want to just take the money after you've cashed in the IRA and leave it set in your savings. You have 60 days to roll it over into another IRA, another investment type situation, so you don't get penalized or taxed on it. You may take only one IRA tax-free rollover in a rolling 12-month period, regardless of the number of IRAs that you own. So this limits what you can do. This includes traditional, Roth, SEP, and simple IRAs. The following transactions are not subject to the one rollover per 12-month limitation, and that's IRA to IRA transfers. rollovers made from or to an employer retirement plan like a 401k to an IRA or an IRA to a 401k, and then conversions, funds from traditional IRAs move directly or within 60 days to Roth IRAs. So if you move it from one instrument into another instrument that is similar like that, like IRA to IRA, then they are not subject to the one rollover per 12-month limitation. Here are some of the distribution procedures. Contribution dollars can be withdrawn from the Roth IRA anytime, tax and penalty tax-free. Earnings may be withdrawn tax and penalty tax-free if this or another Roth IRA has been in existence for at least 5 years and the distribution is made because you have attained the age of 59 and a half, because you have passed away, you've died because you've become disabled, or you need to pay for the purchase or construction of your first home, $10,000 to lifetime maximum. Distributions may be taken in specific amounts as a lump sum or as a series of systematic payments. So there's some qualified exceptions to the 10% tax penalty for traditional and Roth IRA distributions. Now let's talk about the traditional IRA. A traditional IRA is a tax-advantaged arrangement that allows earnings and deductible contributions to grow tax-deferred. So that means when we're talking about being growing tax-deferred, that means that you don't pay income taxes on the earnings and deductible contributions of your IRA until you begin making withdrawals or taking withdrawals. Now, the advantages of a traditional IRA are contributions may be deductible from your gross income on your federal tax income tax return for the tax year for which the contributions are made. Once again, this can be very helpful in keeping you in a lower tax bracket. Earnings grow on a tax-deferred basis. Deductible contributions and earnings are subject to federal income tax when withdrawn. The Saver's Credit may provide a tax credit for those who save for retirement. You may be able to take a credit of up to $1,000 or up to $2,000 if filing jointly. The credit is designed to help offset part of your first $2,000 contributed to a traditional IRA. Roth IRA, simple IRA, or 401k account by reducing the amount of federal income tax you owe dollar for dollar. However, it is not a refundable tax credit. So the credit ranges from 10% to 50% of your contributions. It's based on several factors, including your filing status, adjusted gross income, and tax liabilities. Special rules do apply. Then let's look at some of the distribution guidelines before we start talking about mutual funds. Distributions may be taken at any age in specific amounts as a lump sum or through a series of systematic payments. Distributions are taxed at ordinary income tax rates for the year the distribution was made. Distributions taken before age 59 and a half are generally subject to the 10% tax penalty. In 2019, you were required to start taking required minimum distribution, RMD, from your traditional IRA by April 1st of the year following the year you reached the age of 70 and a half. In 2020, you're required to start taking RMDs from your traditional IRA by April the 1st of the year following your 72nd birthday. So you're forced to take distribution by then. Now, let's go ahead and talk a little bit about mutual funds here. Mutual funds are investment strategies that allow you to pool your money together with other investors to purchase a collection of stocks, bonds, or other securities that might be difficult to recreate on your own. And this is often referred to as a portfolio. I like to invest in mutual funds. I've invested in mutual funds several different times during my lifetime, and I like it because it gives you the opportunity to be a part of something bigger than what you can do by yourself, and it also is a great vehicle for the diversification of the finances that you are investing. One of the things that I would mention to you, though, and it's right here on this slide, is you need to be careful about those mutual fund fees. And so there are a variety of fees that may be associated with the mutual funds. So some funds come with transaction charges for buys and sales or commissions known as loads. Some funds charge a redemption fee if you sell shares you've only owned for a short time. Investors also pay ongoing expenses to cover the cost of operating the fund. So this includes investment advisory fees, which means you're paying the fund manager and the research staff, and transaction costs associated with buying and selling securities within the fund. So when evaluating a fund, remember that fees play a factor and may potentially detract from the fund's performance over time. And so you want to make sure that you know what those funds are. You want to make sure that you know how much that they are, and then you need to be able to see if the cost of those funds is going to be worth paying, depending on how much you're invested and for how long you're invested and what kind of fund it is and what kind of return you're getting, and all of that. All right? So mutual funds are a good tool, but you need to kind of watch the fees and stuff like that so you don't get burned on those mutual funds. Now, stocks, I've done a lot of things with stocks throughout the years. I've bought options, I've bought puts, I've bought calls, I've done straddles. There's a lot of things that can be done with stocks. They're a type of security that gives stockholders a share of ownership in a company. And another word for stocks are equities, and so some people will use the term equities. Investors buy stocks for various reasons, and here's some of them. For capital appreciation, which occurs when a stock rises in price, and so that's a good way to make money. And a good time really to get involved in the stock is at an IPO, at the initial public offering, if it's a company that you think is really going to pop. Once again, all of these investments are a risk. Dividend payments a lot of times can come from a good stock, and that's when the company distributes some of its earnings to its stockholders. Sometimes that's quarterly, sometimes that's yearly, but it's a good opportunity, a good way to make extra money. Also, when you buy stocks, you have the ability to vote shares and influence the company. So you have a say-so in the direction of the company. Companies issue stock to get money for various things, including paying off debt, launching new products, expanding into new markets or regions, and enlarging facilities or building new ones. Now, there's risk involved in stocks. A stock's price can be affected by factors inside the company, such as a faulty product or events the company has no control over, such as a political or a market event. Now, one of the things that I like to do when I'm studying a company and trying to decide whether I want to invest in that company by purchasing their stock is I like to study their leadership. What kind of leadership do they have? Because everything rises and falls on leadership. What kind of history do their leaders have? Do they have a history of success? So what kind of history do they have? And so sometimes you can mitigate some of the risk by being choosy about investing. You're not just investing in a company, you're investing with the people that's actually making the decisions to move that company forward. And so you want to know the quality of people and what their business acumen is. And so you want to have a good look at that. Another thing that you need to look at when you're investing in stocks is you need to look at the fees. Buying and selling stocks involve fees. A direct stock plan or a dividend reinvestment plan may charge you a fee for that service. Brokers who buy and sell stocks for you charge a commission. A discount brokerage charges lower commissions than you would pay at a full-service brokerage, but you generally do not have the research that you would have in a full-service company. So a full-service brokerage costs more, but the higher commissions pay for the investment advice that you are getting based on the firm's research. So a full-service brokerage is the best for a novice investor, and that would be for an investor that hasn't invested very much. And so I want to encourage you here now, like I said before, this is just a video overview. Obviously, it's not a teaching and a training, but it's an overview of what you should be studying. So I want to encourage you to continue reading your curriculum. Study it. Don't just read it, but study your curriculum. Read your textbook. Absorb that textbook and use it to help yourself grow. Listen, don't just try to get through this course. The more you learn, the better it will be for you in the future in your own personal life. So study pages 46 through 57 in the curriculum. Finish up your textbook and prepare and turn in your term paper by next week. And I will be seeing you next week as we finish up Biblical Economics 2. God bless you.